All right, good afternoon, everyone. Thank you for staying with us today. I hope you got your coffee and you're ready for an invigorating conversation on tax. Tax impacts us all. We have some incredible experts here, an esteemed panel, so let's dive right in. Julie, maybe you can set the scene for us before we get into this conversation today. What are we really talking about here? What is the current tax treatment of digital assets?
Sure, thanks, and good afternoon, everybody. First, I need to start with the views that I share today, or those are my own, and I'm not speaking for the agency. So, in the IRS in 2014 issued a notice, 2014-21, and in that notice, it said that what you engage in this ecosystem is a virtual currency. Over the 7 years, we have evolved, and it's now called digital assets. So for most taxpayers, if you sell, you'll have a gain or a loss. If you earn digital assets in performing services, either as an employee or independent contractor, you'll have ordinary income.
So not all tokens are the same, nor are all types of transactions. And at its simplest form, as you just said, Julie, for federal tax purposes, virtual currency is treated as property. Rob, maybe you can help explain that to me, because many would say it often feels a lot like money.
Yeah, absolutely. And a lot's happened since 2014. I think you were part of that effort. Thank you, Lisa. So we talk about digital assets now, and they come in lots of different flavors. And we care about the different types of digital assets from a tax perspective a lot, because the asset used in a transaction type actually influences how do we treat that transaction from a tax perspective. So we have crypto used as a form of payment, right? That which is widely used. And so we have a series of barter transactions triggering gain or loss. Like you said, taking it as income, using it to pay expenses of employees. Those are barter transactions, all of which trigger gain or loss, which is complicated. But we have other types of digital assets. So we have to say, what are the rights and obligations of those digital assets attached to the holder, right? If it's just used as a means of exchange is one thing, but what if it's attached to a protocol? What if there's a governance right that is granted technologically, and maybe the legalese is a little bit gray? We have to say, what does that represent? And then how is that used in the transaction flow? Or what about an NFT? And so then taking a step back and saying, how does that change the tax analysis when we have to interpret it in the real world, particularly here in the US, we need to report these transactions. And so it's what does it represent? How does it impact the transaction flow? So we talk about the span. There's lots of different types out there, not all being created equal, and a lot has happened since 2014.
Yeah, and you might ask the question, why do we care? Why do we care what the rights and obligations and what these various tokens are treated as? In 2014, the notice just said that virtual currency is treated as property. It didn't identify what kind of property. So that matters for purposes of the code, because we have frameworks in the statute that deal with different types of property. We have a framework that deals with securities, framework that deals with commodities, framework that deals with currency, with intangible assets. And so what we try to do is figure out, what does the token represent? What bucket are we going to put it in for purposes of figuring out what framework in the Internal Revenue Code applies?
Everyone in this room knows tax day is upon us. We're a little more than 2 weeks out. So Lisa, maybe you can expand on that a little bit. You know, what are the key considerations for taxpayers when it comes to reporting digital asset transactions, and how can they ensure compliance with the tax laws?
I would say the number one thing is to report. You may make mistakes, that's okay, but the digital asset transactions should be reported on your Schedule D, or 8949, which rolls up into Schedule D. So all of the transactions that you engaged in during the taxable year should be reported. And the one thing to note too, the Form 1040 has a question on the front of the form, very prominent, that requires you to check a box, yes or no. Did you have at any time during the taxable year, did you receive, sell, exchange, dispose of, gift any digital assets? And you actually have to check the box yes or no. Presumably if you check yes, the IRS is going to look at your Schedule D to see if you reported anything. If you check yes and you don't report something, then you just be prepared to explain why you didn't report anything as income. It may not be income. You may have had full basis to offset it. One thing to note, that's for on the individual side. Businesses also would have reporting obligations. We have seen businesses accept cryptocurrency as payment for goods or services. If they do so, they're supposed to report the value of it as income, just as they would if they receive cash for those services or goods. Some businesses use crypto to pay employees or to pay vendors. As Rob was talking about, those are barter transactions. Every time you spend cryptocurrency, it's an exchange. It's a taxable exchange, so you have to recognize gain or loss on that transaction. If you are paying employees in cryptocurrency, the value of that cryptocurrency has to be reported on W-2. You have to do the income tax withholding and FICA tax based on the value of that. We are still not at the point where you can pay your withholding tax in cryptocurrency, so you would actually have to probably sell some of that cryptocurrency to pay the withholding tax.
We don't take it yet.
Not yet.
Yet.
I like that. I like that.
You'd have to convert it.
Yeah, I mean, the bookkeeping nature of this is important. None of us grew up in a world of barter transactions, so we're not used to just freely using crypto, which moves in value all the time, but for a few stable coins out there reporting barter transactions, this is complicated. And as Lisa said, we need to report these things, so it's a little wonky. So think about an entire set of books and records with digital assets moving through all of your typical transaction flows. Think about it through your revenue cycle, your payroll cycle, your vendors, right? Crossing borders. What about your international affiliates? We're not used to living in that world. And so the record keeping is critically important because every time you're using it, not just diversification of one for another, but literally moving it to another party, we're triggering gain or loss. And in a world where most of us have grown up using fiat-based currencies and transactions, now we have to report everything on the use of those. That's a little bit wonky. The record keeping is critical. And so, the burden is on the taxpayer, last I checked. And so we need to report those transactions. This gets complicated. And the burden is on us, not just to report the transaction, but what was its nature? How does it correlate back to, nothing's really going to tie back to a cash flow statement, which is the typical exam process, right? And so now we need to say, how do all these transactions culminate back into something that can tie back beyond a set of books and records, back to cash at some point? Incredibly complicated from a record-keeping standpoint. You might have a comment about that, Erin.
Yes, so I think that I would pose the question, does anyone do their taxes manually or maybe even by themselves, right? We have wonderful advisors like Rob or Lisa telling us the what, but then how do you achieve the how? And it's extremely complex just to prepare your own taxes, without crypto involved, and then you add in crypto, extremely complex data, very dense, manually calculating that and then reporting that forward on a tax return, I would say is nearly impossible. So you take the what and you productize it in the how, and that's obviously coming from the TaxBit side of things. What we're trying to empower is to facilitate that ability to accurately report forward when you are investing in crypto.
Let's change gears a little bit and let's move to the regulatory developments in taxation. We are in Washington after all, and we do have a regulator on stage. But Erin, let's start with you. When I wrote this just yesterday, the IRS hadn't put out guidance on cryptocurrencies since October of 2019, and that was the release of Revenue Ruling 2019-24. That's changed as of this morning, and we'll touch on that a little bit. But how has the regulatory landscape shifted over the last few years as we discuss taxation and treatment of digital assets?
Yeah, it's a great question. So over the last few years, we have something which we will touch upon, which I think everyone in the audience knows something about, which is the IAJA, which we're going to get into. But from the IRS, we haven't seen a ton of regulation, right? We've been weighted with bated breath of the coordinating 6045 regs, which I think we all hoped would drop, and we'll have a follow-up conference on that. But we have started to see actions from the IRS that tell us that they're listening to industry, right? They're listening and learning, and they understand clarifying and issuing, whether it's informal or formal guidance, is very important across the industry for many different reasons. So as Julie mentioned, we've seen the shift from digital currency to digital assets, which is a coordinating effort with other regulations we're seeing in that language. We've also seen two pieces just since January of this year. They're the Chief Counsel advice, two important clarifying points because it's tax season is upon us, right? Where they've clarified that crypto donations over $5,000 need evaluation. Now, while that clarification is wonderful, it probably also raises other questions of how you're going to value certain cryptocurrencies, things like NFTs, because that valuation is not readily available. The second clarification was on the what can you deduct when your token loses all of its value? Now, unfortunately, we've seen that happen in the last year. So people, taxpayers preparing their own taxes right now are going to be faced with a decision of, can I take that loss, even though I haven't done anything, but my token has lost all of its value since I acquired it. So really important movements overall, and movement is good, right? And we have even more movement today with the issuance of Notice 2023-27, which touches on commentary for NFTs, and I'll defer to Julie.
Great. Yeah,
on
so
that.
very exciting news today. Not regulation, but it is the notice, and it's treatment of NFTs as collectibles. And what I want to reiterate and state, and you've heard it today, that it's collaboration with all of us. We are listening at the IRS. We do want to hear from you. This notice is evidence of that, and it is a notice period of 90 days. And there's certain questions in here that, and I would venture to say there may be more that we haven't thought of. So please take the time to let us hear from you so that we can get this right. I think it's imperative in this space that we get it right. And we, as an agency, can't do it without all of us. And I'm not from Atlanta, but I'll say all y'all, right? We can't do it without you all. And so I will say too, just a little plug for my office. I am the project director of a small but big office at the IRS where we are working in collaboration with you and industry, with our partners in the private sector, certainly, with software computations within our own agency. So it's a very exciting time, but to get it right, we need your help.
Mm-hmm.
We thank you for the comment period.
Yeah.
Yeah, definitely.
For sure.
And I will also point out too, I think the procedure by putting out a notice first, seeking comments before you do something like proposed regulations, gives everyone a chance to kind of comment twice, right? Comment first on overall approach, and then comment again once an approach is decided by the IRS. I think that's an appropriate approach, I think, for this space.
And I love how this seems to give us a foothold, because just like we were talking about not all digital assets being created equal, right, but the notice puts out some references to like, hey, let's look down as to what this really represents, right? Let's really dig down, and that may be different things to different people, but fundamentally, what does it represent within the construct of the code or the protocol it may be attached to, or maybe something that is demonstrated by a seller. And so allowing us to get down to that level, I think, transcends well beyond NFTs, right? If we could just carry this concept and say, let's go now beyond NFTs to the broader spectrum of digital assets and what they represent. Back to our first question, this is massive. And so opening that door is greatly appreciated.
So the notice from this morning is not the only thing that we're looking forward to commenting on as an industry. We have had some other regulatory developments in this space in the treatment of taxation treatment of digital assets. In 2021, we had the enactment of the infrastructure law, the IIJA, which imposes a new reporting requirement on brokers of digital assets. We also had the crypto asset reporting framework, an international framework for tax reporting. Lisa, can you please help explain the implications for investors and businesses operating in this industry with these two developments?
Sure. So the Infrastructure Act extends broker reporting to digital asset intermediaries. And basically what this means is, when you get a 1099-B from your securities broker, your stockbroker, that reports all of the transactions that you engaged in during the year, and then you can take those and transfer them to your tax return. That's basically what is going to happen now for digital asset transactions. And the OECD process is very similar, but it's on the international stage. So they have released a crypto asset reporting framework that if a country adopts it, will allow for the exchange of information between countries. So for example, if you're a US person and you open an account or a wallet at, say, a UK exchange, then that UK exchange will report on you back to the IRS. So there'll be this cross-border exchange of information. And it was very interesting to note that the crypto asset reporting framework was pretty closely aligned with the broker reporting requirements in the Infrastructure Act. I don't think that was by accident. The US Treasury Department was pretty involved in the OECD process. And they have said publicly that they think they have the authority, based on the broker reporting provision, to adopt the OECD crypto asset reporting framework and to be able to exchange that information with other countries. And so we could see, we are waiting on proposed regulations. We've been waiting for a little while. They have completed their review at OIRA and are back at Treasury, and so we were hoping that they might drop before this conference, but they have not yet. And so the process will be that they'll release the proposed regulations. Stakeholders will have a chance to comment on those regulations. Then they'll issue final regulations. IRS has already announced that they will not start requiring the reporting until those final regulations are issued, which was very welcome guidance, I think, coming out from the IRS. So within the next few years, we could basically be living in a tax world where there's pretty full transparency in the types of transactions that people are engaging in. While on the one hand you might think, well, that's burdensome for the intermediaries that have to establish the systems to do the reporting. On the other hand, it will provide very useful data to the users who then have to take that data and put it on their tax returns. So I think you will start to see higher compliance in this area once all of the reporting is implemented.
And I think it'd be easier, right, also to prepare the returns of your clients, and then also for, like you said, the users or people engaging in this space to know and have that transparency on whether they have a taxable event or not.
Yeah, most Americans aren't used to putting something on their tax return unless they get a 1099 or some indication of what to put on there.
Some sort of something.
Right, some sort of something. That's well said.
I think it's equally important we focus a lot on the consumer, right? Receiving their 1099, being able to file their own tax returns. But it's equally important, the regulations on the enterprise side, right? So for businesses that are looking to go into the digital asset industry, I think one hesitation is what is required of me? What is required if I, go to market with a product? Am I going to be subject to certain compliance and reporting obligations? Am I not? That uncertainty can also hinder industry growth. So I think it's equally important on the enterprise side to clarify and get those regs.
100%.
Sure, yeah.
So what we're talking about today is fairly novel and it's complicated. I don't remember digital assets on my tax law course, and I'm sure for the many, many lawyers in this room here, digital assets wasn't on their tax law syllabus. So we're trying to apply the existing tax code to these novel concepts. For example, taxation treatment of staking and mining yields. These are novel to many people, and they've led to a lot of legal action and questions. So Erin, maybe you can help expand, how are those yields currently taxed and what are the implications for staking, and maybe get into some of these other concepts?
Yeah, the taxation and staking, it can definitely be very complex depending on the certain scenario that, is the product and how that product functions. But overall, I would say from a very high level, when you stake and you earn those rewards, they are treated as income. Now, there's a lot of different complexity that I think we've seen come about this year with exchanges, unfortunately, going into a state of bankruptcy, and then your yield rewards are locked. Or you have certain, protocols that aren't yet public, so you can't get those staking rewards. So that's why I say at a very high level. And as quickly as we determine the tax treatment, there is a shift in industry that may change that classification. So we have to be able to be dynamic for those situations that arise.
There's also different points of view. I mean, use the word earned. I know some people talk about,
Yes.
Services. I'm going to use the word actions.
Yeah.
So if you're directly interacting with the protocol, and by the way, all staking protocols quite different in how this is enabled, and there are actions related to the protocols and the rewards as they come to the owner of those assets. If you're the first owner of that reward, are we sure that correlates to a service? Are we sure that it correlates to income? Because while accession to wealth has been around a long time and it's very broad, there's also something like the acquisition of property, which correlates to if you're the first owner, which may happen in this instance. So I think as we come about with guidance, hopefully it will be thoughtful guidance and allow a notice or a comment period so that we can really thoughtfully examine what are the dynamics here and make sure we get it right. A lot's changed since 2014 when the first notice was put out, right? We first saw this comment, right? Staking didn't exist.
Addressed,
It was barely a comment at that point, right? We didn't have it. We had Bitcoin, Dogecoin, Litecoin, and XRP, I think, at the time. So a lot's changed. So let's examine what that really is. What are those actions? What do they mean to the technology? And then how do we address that? Also, what is your role in interacting, right? You have the rights attached to that token. How are you interacting with another party or directly to the protocol? And how do those actions translate back to you?
Yeah, and another question too is whether, how it relates to mining. So mining was addressed in the earlier notice, and rewards from mining are treated as income, and the notice and the FAQs that are posted on the IRS website suggest that it's compensatory, that it's compensating for some sort of service that you're providing to the distributed ledger, and you might question whether you should revisit mining as well.
Respectfully to the authors of the notice, of course.
Yes. Things change, right?
Yeah.
But it is time to revisit stuff like this. We have so many, we have hundreds, if not thousands of examples of those right now. Let's get it right. And importantly, it's the infrastructure that drives much of decentralized ledger technology, right? It's mining, it's staking, it's other stuff. Let's get it right.
Yeah, Rob, on that, let's talk about another unique challenge, DeFi, decentralized finance. How do different forms of DeFi transactions like swaps, loans, derivatives impact taxation, and what are implications for businesses operating in the DeFi space?
Yeah, nice spicy meatball for the panel. So DeFi, right? All DeFi again, different, and so we think about DeFi indexes or DeFi lending, and I think sticking to basics just for a moment, there's different theories about when you enter that protocol. That leg one, is that an event such that that's leg one event? It does something on the inside, and then when you exit, that be another transaction. An alternative point of view is that the benefits and burdens of ownership translate into the protocol such that the churn of that asset while it's in the protocol could be generating gain or loss transactions or ordinary income, depending upon your trader business, all the way throughout. So every protocol is different. There's different points of view on this. And I think you really need to look at the facts and circumstances of the taxpayer. But again, lack of guidance, I think a reasonable approach, as long as you're reporting it in some manner that's consistent and rational. Maybe, Julie?
Yeah.
Sure. I think you do need to look at that, right? It's what's reasonable, and do your due diligence.
Yeah, and I will just note too that while there's a statutory exception for loans of securities for tax purposes, that doesn't give rise to a taxable event, that exemption does not extend to digital assets. Now there have been some legislative proposals to extend that exception, so that's another consideration.
back in the Green Book.
I think DeFi also highlights a big challenge across the crypto industry, right? Even let's say that we can come to a consensus what that first leg tax treatment is. We can come to a consensus about what's happening within the yield pool in the exit, right? How then do we understand what's happening from the data? The data, there's no standard data model. It's extremely complex, on-chain, off-chain. So while we may agree how it should be treated, we have to understand what's actually happening from the data, and that is extremely complex. And shameless plug, where you need product again to help you.
So we have only a few minutes left, and let's look forward. Let's talk about the future. Tax isn't going anywhere. Neither are digital assets, if you feel the energy in this room. Is it sustainable to continue to fit some of these novel transactions in the digital asset space in the existing tax regulatory framework? Or does there need to be a whole new framework? And what else should we look for going forward? And maybe we can just go down the line. We'll start, Erin, with you.
Sure. We were having a conversation earlier today talking about the automobile industry, right? And the overall expansion and the regulation. And I think one thing that history has shown us is that in order for an industry to succeed and be able to grow, it takes collaboration between industry and the regulators. And that conversation needs to be continuous and fluid, especially in crypto. We will have regs today, and there will be a new crypto event or scenario that is not covered by those regs. So we have to be able to continually adjust so that the industry can grow.
And I'd piggyback on that, and it's critical to work together in this space. The speed is so quick, just like what Erin you were saying, right? There's probably something or some things that are new today with us being here, and we'll hear about it later. So for us as a regulator, we need to know those things, back to getting it right. And that's working together, it's collaborating, it's being at events such as this so that we can hear, we can develop the relationship that we then can work together to do it right.
Yeah. 100% agree with you. And I mean, we can all agree that this is truly transformative technology, and digital assets are probably just that first leg of this journey. Commissioner Pham yesterday, she made this reference, I hope I get this right. She said, look, blockchain digital assets, this is the first leg of our journey. It's the first waypoint on the journey to the metaverse. And I'm like, that's a great way of framing this, because we've been talking about elevating commercial activities for a long time. But when you think about what it means when we're in a world, and how do you translate a world that's not exactly like believable quite yet for me anyway, and then you translate it back to the meat space, and how do we deal with that from a transaction flow standpoint? This is essential that we nail this now. We're dealing with baseline stuff. Let's get the base set with all these different transaction flows, because this is only going to get way more complicated. But importantly, that innovation and what it means to us as a nation and broadly the world, right? We got to get this right. Otherwise, we've lost this great opportunity to innovate together.
Yeah, and I guess I would just piggyback on the the speed of change. Cody, you asked about whether we need a new framework. We need a new legislative framework for digital assets. And I think if we were to do that, we'd be in the same boat shortly, right? Because it would take time to implement that new framework, and then the industry would have advanced past that. So you'd still be in the same place trying to fit this new technology into these old frameworks. And, it seems to me that we have a lot of different frameworks, as I mentioned earlier in the code, that deal with different types of assets, derivatives, different types of transactions. And I think just working with the government to help us determine which of these frameworks it fits in, I think we have the basic, I think the code gives us the basic idea of how to tax this.
Tax day is in 3 weeks. If you have questions, ask these folks on the stage. Ladies and gentlemen, please give it up for our tax panel. Thank you so much.